Evening, everyone. Hope you all are doing well. So today we are going to discuss IFRS 16, which is one of the most important and the most demanding IFRS of today's world. Okay. Most of these students ask that your lectures are summary lectures and the duration of your lectures is less than other tutors. No, these are not the summary lectures. These are the, I would say, best lectures for your exam perspective. Yeah, I can understand that the duration of my lectures are short, but let me tell you why the duration of my lectures are less than the other tutor. First of all my lectures are recorded. All the content have been written by me previously, then I record the lecture. While in your other tutor lectures, they write down the content while conducting the classes. That's the one reason. Also, the second reason is they take time while explaining the things, which further increases their duration, which in my case is not possible. Also, I am uploading all the lectures on daily basis, whereas their lectures have been recorded in the past. At that time, they were conducting a live classes. So these are the reasons. Based on that, their duration is longer than mine. Before wasting further time, let's move to the content. So IFRS 16, which we are going to discuss today, about two perspectives. The first one is lessee and the second one is lessor. Now first start with the definition. Definition of IFRS 16 leases is a contract that will convey the ROUA right of use asset for a period of time in exchange of consideration. Means lessee obtained the ROUA right of use asset for a period of time means for lease terms in exchange of consideration in exchange of something. Now accounting by lessee. For lessee books, all leases are finance lease. Means in the IFRS 16, whenever a lessee obtain any assets on lease, lessee always follows IFRS 16, which is finance lease. Lessee will never use operating lease. Now read apply IFRS 16. Recognize ROUA and lease liability. Once lessee obtain any assets on lease, the entry is ROUA debit, lease liability credit. Depreciate ROUA over time and amortize lease liability and pay lease liability over the lease term. Now, do not apply IFRS 16. There is an exception when lessee will not apply finance lease. Lessee do not apply IFRS 16 in case of short-term lease, less than 12 months and low value assets. Assets whose value is lower. Now, lease payment shall be recognized as an operating expense. In this case, lessee follow operating lease means expense based. Recognition of expense shall be based on usage of assets held in the lease. In this case, no need to book ROUA or lease liability, just book as an expense. Short-term lease. Informed at the commencement date that whether the asset is leased for 12 months or less than 12 months. If a lessee obtain an asset on lease for 12 months or less than 12 months, then this is considered as short-term lease. And in this case, lessee will follow operating lease. If there is an option to purchase at the end, then it will not be considered as a short-term lease. Why? Let's go through this example. Always check the term, never ever make decision based on the value. In the short-term lease, you always make your decision based on this 12-month period. For example, lease 1 period is 12 months and the value is 200 million, where the lease 2 term is also 12 months, but the payment is 70 million. Identify the short-term lease. Both of them are short-term lease because their lease period is 12 months. Now, purchase option. In the money means beneficial for lessee if lessee expected to be exercised by the lessee, not short term, not expected to be exercised by the lessee, then it will be considered as a short term lease. Also, in case of out of money, not beneficial for employee, also it will be considered as short term lease. Only it will not consider as short-term lease when the lessee opts purchase this option. Means at the end, lessee will purchase this lease. Now, what is a low value asset? Assets of 5,000 or less, it is written in basis of conclusion in your standard. Value of new asset is considered for this criteria. It means when the fair value at the date of new launch into the market, means whenever any asset launch in the market, the fair value of that debt will be considered. Exception is available on asset to asset basis. It's not necessary that on every low value asset IFRS 16 is applicable. When IFRS 16 is applicable, when the above conditions are fulfilled. These are the conditions. Asset is for specified use, means specific asset. Right to use has been transferred to lessee in exchange for consideration. This is a definition. For the finance lease IFRS 16, this criteria must be fulfilled. Now, finance lease, long lease, and operating lease. First, read what is finance lease. It's like bought an asset on loan. It's normally for the major life of asset. In finance lease, repair maintenance responsibility of lessee. Machine debit, finance lease obligation. You can also write ROUA. When long lease is a loan, so its rentals will be treated as repayment of loan. Loan debit means the cash you are going to pay as a repayment. Interest expense, the amortization on the present value of rentals and cash. So this is the entry when you are going to repay the loan. Operating lease, short lease, it's like taking an asset on rent. It's for short period of time, no asset, no loan, just record complete rental as an expense. In finance lease, repairs maintenance responsibility of lessor, rent expense debit, cash credit. This is the entry for the operating lease. If lease term and life of asset is different, if asset is expected to be transferred to lessee at the end of lease, then always depreciate it over the life of asset. It means if it is mentioned in the lease agreement that at the end of lease term, the risk and reward of this asset will be transferred to lessee, then the lessee will have to depreciate it over the life of asset. If asset is not expected to be transferred to lessee at the end of lease term, then depreciate it at lower of lease term. Life of asset, whichever is lower, will be used for the depreciation. Application of IFRS 16. First is lease liability. What is a lease liability? Present value of all payments made to lessor, after commencement date, means after the commencement of the lease date, is a lease liability. ROUA, present value of all payments made by the lessee to all parties. It could be lessor or it could be third parties, such as installation cost, incremental, any. Now there are criteria. First, inception date. Inception date means lease agreement date. Pre-commencement payment made to lessor not become part of lease liability. Why? Because after commencement date, now B is a commencement date on which lease asset is available for use by lessee. Down payment to lessor, will it become part of lease liability? No. Why? Because it is on the date of commitment and the criteria is after the commencement date. Initial direct cost to third party, no, because it is not paid to the lessor and also not paid to the after the commencement date. Installation cost to third party, these costs not become part of lease liability. Why? Because these payment made on the commencement date rather than after the payment commencement date. See lease term. Use period including optimal periods. Lease rentals to lessor become part of lease liability. Why? Because it paid after commencement date. Purchase. Acquisition of asset after lease term. Exercise price to lessor become part of lease liability. Dismantling of asset at the end of its useful life. Dismantling cost to third party become part of. No, it will not become part of this liability. Why? Because it paid to third party. Dismantling of an asset at the end of its useful life. Dismantling cost to third party. No, it will not become part of lease liability because it's paid to the third party. If first payment now means in advance you are receiving your rentals. So in this case, no interest element as interest due over time must be treated as a pure decrease in loan. Of course, you are not going to pay any interest, so your entry will be lease liability debit cash credit. Now there is a question on this interest payment now. Inception of lease at 1st January 2006. Lease term 3 years. Interest rate implicit in the lease 10%. Rental 20,000 per annum in advance. Read this line very carefully. Why either the payment made in advance or in arrears. Annuity factor for 2 year 1.736. Now, financial statement extra for the year end 31st December 20 Answer. ROUA and lease liability 54711 54711. How you will identify or calculate this figure? There is a formula for you. Rentals multiply by formula 1 minus 1 plus I interest power minus n means number of lease term divided by I means interest, then multiply 1 plus I. If there are any rentals in advance, then you will have to use this formula in order to calculate the present value. Now put the figures in this formula, you will calculate 54711. Now we have just studied in case of advance there will be no interest as interest due over time. So lease liability by 20,000 debit, cash 20,000 credit. Now lease amortization schedule, I would highly recommend you to make a lease amortization schedule as it will help you in solving your question. Once you make an amortization schedule, then understand that your 50 to 60% question has been solved. Now just extract the data from this schedule. There are 3 year lease term as you can see. 3 year 123 present value 54711. Lease liability value advance because we receive in advance 20,000. Balance is 34711. 3471 38182. Balancing figure plus interest gives the closing. Now on closing you will again have to deduct 20,000. You will get 18182. Add 10% interest 20,000. 20,000 advance payment less zero balance. So you can see the at the end of the lease term the balance is zero, means we have paid the lease liability. Now interest expense, accrued interest. Why accrued? Because interest spread over the time. Depreciation expense, ROUA. How we identify this depreciation? ROUA divided by 3 gives you this figure. Now extract of statement of financial position. ROUA is 36474. ROUA minus this depreciation gives this figure. You can understand or you all know that in statement of financial position we took the closing figures. Now non-current liability, the non-current liability is 18182, this one figure, this one, and the current liability is 16529, and accrued interest is 3471. So I just accumulate both the figures in current liability as accrued interest is also. Now there is a question too, which is if the payment made in arrears. First we have solved if the payment made in advance. Now we are solving if the payment made in arrears. So Jumeirah Limited leased an asset on the following terms. The company made a token as pre-commencement payment on the date of agreement 31st October 2016, rupees 50,000. What do you think? Will this amount be included in your lease liability or ROUA or in both? Just go to this table. This is your life saving table. ABC. This is your life saving table, life saving application. So at the inception date, no, not become part of LL means lease liability. So this will only be part of ROUA. The lease commenced on 1st Jan 2017 with the down payment made by Jumeirah Limited 120,000. It will also become part of ROUA, not LL, because it's paid on the commencement date, not after the commencement date. Annual rentals at the end of every year. Of course, this will become part of lease liability. So we will have to find its present value. Interest rate applicable to the lease is 12%. The lease term is non-cancelable period for 4 years from the date of commencement. Residual value at the end of lease term is expected to be 10 is expected to be 1 lakh. The lessee has not guaranteed any of it. Whenever it's mentioned that the lessee has not guaranteed any of it, so we will have to ignore this residual value in case of lessee finance lease accounting. At the commencement of the lease, the lessee has paid initial direct deposit of 40,000. Of course, this will also become part of ROUA, not for the LL lease liability. The company is given a laptop having a fair value of 30,000 as an incentive at the commencement of the lease. This you can say other assets given at the commencement of lease. So it will also become part of ROUA, but we will calculate it separately because it's also a non-current asset. Useful life of the laptop is 4 years when an estimated residual value at the end of useful life. So we will have to deduct this from this figure in order to calculate the depreciation. Installation cost incurred on the asset rupees 1,50,000 at the commencement date. Installation was a very small process and the asset was ready to be used on 1st Jan 2017. This is also become part of ROUA, not lease liability. The asset will need to be dismantled at the end of the lease term at a cost expected to be 2,50,000. Of course, dismantling cost at the end will also become part of ROUA, not with the lease liability. Now, there is a note for you. Residual value relates to lessor, not with lessee. It's mentioned in the case. Lessee has nothing to do with point number 6. Particulars cash flows present value at 12% nature. Okay, pre-commencement 50,000. So of course it's this 50,000 is at the start of the year. So we do not need to calculate its present value as it's already in the start of the year. Now down payment also in the start of the year, so 120,000, 120,000. No need to calculate its present value. But rental paid at the end of the year, so we have to calculate its present value on the day one. So 2 lakh is the per year rental which paid in arrears. We have to calculate its present value, which is 12%. How you guys can calculate this present value? You just have to follow the formula which I have discussed above in case of advance. But if you can see in the advance formula, this one, you do not need to take this factor. This factor is only for the advance. Rest of the formula will be same for the areas. From rentals to this bracket, you can use for the areas. But if there is advance, then you will have to incorporate this other factor as well. So use this formula in order to calculate the present value. It will give you 607,470 lease liability. Initial direct cost 40,000, 40,000 because it's paid on the commencement date. So no need to calculate its present value. Installation cost also paid at commencement date 1,50,000, 1,50,000. Present value of decommissioning, dismantling cost 2,50,000 at the end of 4 years. So we will have to calculate present value is 1,58,800 other liability. Now total contribution paid for ROU and incentive is 11,126,350, in which we have to deduct this incentive value left of 30,000. So the payable or paid for ROUA is 109,6,349. Now Lease amortization schedule. It's time saving schedule. Air 1234, Air 1607. You can see the 607 here. It's mentioned 607. So in this table, only one figure is the lease liability. Rest of all are related with the ROUA. Don't incorporate this figure as a lease liability. This is other liability, not as a lease liability. Okay. So 607470 at interest 12%, 2 lakh rentals in arrears. So in case of arrears, you will have to make this kind of amortization schedule, whereas in advance, the schedule was little bit different. So it will give you 483 closing figure, which you write in start of year two, then again interest, again you have to deduct 2 lakh rentals, then this, and then at the end you will get zero because you have paid all your lease payments. Now present value or provision for dismantling. This is the present value which you have calculated in the above table. After that you will apply the 12% interest, gives the closing figure. You can ask, or you can think, why we are not deducting any payment from this table even though we have deducted in this one. This is for the rental, this is for the dismantling cost. We have calculated this present value, then we will reach to the figure or reach to the value which we would pay at the end of 4 years, which is 2,50,000. Now this is called unwinding. We are doing it unwinding. Now then interest plus opening, closing, again you apply interest, this, at the end you will reach this figure, 2,50,000. Okay. Now journal entries. ROUA 1096. From this table, 1096 ROUA is your debit. PP 30,000, PP relates with laptop or incentive. Cash 3,60,000. Now, lease liability 607, present value of rentals, provision for decommissioning cost, present value 158880, depreciation expense ROUA. This is how you calculate the depreciation expense for laptop. How you will calculate the depreciation, 30,000 minus residual salvage value divided by 4 gives you this depreciation. Interest expense 72896. This figure you can identify from this table, 72896. Now lease liability, cash 2 lakh, rentals. You can also combine these both entries. How? You will have to debit your interest expense by 72896, then cash with the 2 lakh, then the difference will be lease liability, which will be debit. Interest expense, provision for decommissioning cost 19066 from this table. Okay. Now, extracts of statement of financial position, ROUA 822. Out of 1096, you deducted the depreciation. Same goes for the laptop. 30,000 is the cost, out of which you deduct depreciation, gives you 23700. Total value of non-current asset is this one. Non-current liabilities. Lease liability is 338010. From here, 338010. Okay. Provision for decommissioning code also from the above schedule. Then lease liability 148266. Total liability is this, and you deducted non-current liability, so it will give you the figure of current liability. Now extract of statement of financial profit and loss. Depreciation of ROUA, depreciation for laptop, interest expense for lease liability, interest expense for decommissioning cost. Total expense for the year is 366,652. Sale and lease back, most important topic. If sale meets the criteria, what is meant by sale and lease back? First you sell your asset, then after few years you lease it back. This will be treated as a sale if you meet the IFRS 15 performance obligation criteria. If you are not getting the performance obligation or IFRS 15 criteria, then I would recommend you to watch IFRS 15 lecture on my YouTube ACCA PassPoint channel. Okay. You have to ensure these things. If sale meets the criteria of IFRS 16, performance obligation satisfied. Step 1, de-recognize asset. Step 2, book gain loss on disposal up to the rights transferred. Up to the rights transferred. Book RTU or ROUA up to the rights retained. Okay. If sales does not meet the criteria of IFRS 15, performance obligation satisfied. Don't de-recognize asset. Don't book any gain loss on disposal. Just book the proceeds as a non-current loan. If you are not meeting the IFRS 15 criteria, then you will have to record the proceeds as a loan, means cash or bank debit, or loan proceed as loan payable. Okay. Step sales and leaseback if meeting the IFRS 15 criteria. IFRS 15 criteria: present value of lease liability or minimum lease payment. RTU retained means right of use assets and entry. Okay, how to calculate RTU in this case? RTU means ROUA, right of use asset. RTU, right to retain or right to use, whatever you call. Carrying value of asset multiplied by present value of lease liability divided by the fair value of asset. Let's solve one question. Fair value of asset 7 lakh. Company sold asset for 7 lakh and lease it back for 4 years at annual rental of 80,000 per annum in arrears. Carrying value of asset at the date of disposal 5 lakh. Interest rate 10% per annum. Journal entry. First, identify the present value of lease liabilities 253,589. Payment made in arrears. So this formula 80,000 multiplied by 1 minus 1.1 power minus 4 divided by 0.1 gives you this present value. ROUA 5 lakh. Carrying value of asset, you can see 5 lakh multiply by present value of lease liability, which is 253,589, divided by fair value of asset, which is 7 lakh, gives you the ROUA 181135. Okay, now entry ROUA 181135. Cash means proceed 7 lakh. Carrying value of asset, recognizing the asset 5 lakh. Lease liability 253,589. Gain is the balancing figure. It could be lost, but in this case you are getting the gain as a balancing figure, which is 127546. Okay, if sold for more than fair value, it's the continuation in IFRS 15, means sale and lease back case. If sold for more than fair value, it means the fair value is 700 but you sold in the 800, then what is the treatment? Okay, then excess of sales value over fair value will be treated as a loan, means out, let's say 750 is the fair value and 800 is the sales proceed, so the difference is 50, will be treated as a loan, and obviously this loan repayment is included in future rentals. This loan element has nothing to do with ROUA, so we will have to deduct this loan from the present value of renters in order to calculate the ROUA. ROUA would still be based on present value of lease rentals. Question number 1. Selling price 8 lakh, fair value is 750 lakh. Now, present value of rental 526,797, carrying value is 6 lakh. Answer: first, eliminate the loan component from present value of lease liability. Present value of lease liability is 526,797. Loan portion 50,000. How? 8 lakh minus 7 lakh 50,000 gives the 50,000 loan. Pure present value of pure lease liability, which is 476,797. Based on this figure, we will calculate the ROUA. ROUA, I have shown the formula above. 6 lakh multiplied by present value, which is 476, divided by the fair value, which is 750, gives the figure of 381,438. ROUA 381,438. Cash 8 lakh. Lease liability 527. In this case you also getting the gain as a balancing figure. So case number two, if sold for less than fair value, it means in this case the sales proceed is less than fair value. So what is the treatment? Okay. Then excess of fair value over sales price will be treated as a repayment. In this case, let's say you are selling your asset at 7 lakh, whereas the fair value is 750. So this 750 and the 700 difference, which is 50, will be treated as a prepayment. Formula for ROU retained. ROU equal to carrying value of asset at the date of disposal multiplied by present value of lease liability plus repayment divided by present value of asset. There is a question for you. I would like you to solve this question by your own. Now there is a special case for you. Let's say we took a house on lease, rent, and also taking maintenance services from landlord. Now, according to old IAS 16, from previously it was IAS 17, now it is IFRS 16. House rentals were operating lease rentals. That's why both house rentals and maintenance survey used to go in P&L. But now in IFRS 16, as all leases are finance lease for lessee. So now if we are paying total payments to landlord to lessor, which includes lease rentals plus maintenance payments. So we have to apportion the total payments between the lease rentals and maintenance charge on the basis of standalone prices. Standalone concept we have done in IFRS 16 lecture. Lessor accounting. Now we have done with the lessee accounting. Now we are moving towards the lessor accounting. Lessor still follows old approach. Means it could be finance lease or it could be operating lease. Now read the finance lease. Case number one. If lessor is not a manufacturer or dealer, in most of your interview, the interviewer can ask you this thing. Interview can give you an example. Let's say ABC sells its car to third party. So what is the entry? You can't directly made an entry that bank debit or car credit. You can't always make an entry in case of sale car with regard to IAS 16, which is PPE. You have to cross question with the interviewer. Tell me whether the seller is a manufacturer or dealer or is not a manufacturer or dealer. Is the ordinary course of this seller is to buy and sell car. So you have to cross question the interviewer. Now read. If lessor is not a manufacturer or dealer, lessor purchase a machine. Of course, if he is not a manufacturer or dealer, he would have to purchase a machine. Lessor purchase a machine, entry machine, debit, cash, credit. After purchasing, risk and reward transferred to the lessee. Once lessee go to the lessor and ask, I want to purchase or I want this machine on lease. On this date, lessor made this entry. Finance lease receivables, machine debit against the machine. Of course, he will get some consideration. If first payment now means on the spot, the lessee made the payment to the lessor. So lessor made this entry. Bank debit, finance, lease, receivable. If rentals in arrear means payment made by lessee to lessor in arrears, then bank debit, interest income, finance, lease, receivable. For this, you have to make an amortization schedule. Case 2. If lessor is a manufacturer or a dealer, as lessor here manufactures a product and then sell it, so here he will book two types of income. Sale income book now, interest income will book with respect to time. It means if payment made now, so interest income will be in arrears. If in arrears, of course he will book some part as interest income. Now inventory debit, cash credit, of course here the lessor will purchase inventory 100 finance lease receivable 250 on the sales. Cost of sales, inventory, of course you will have to debit the cost once you are selling your inventory. Now, if rentals in area, bank debit, interest income or FLR. Now there is a concept of residual value which we have just take in the question number 1 while we were solving which was Jumeirah Limited. Residual value, the estimated amount that an entity would currently obtain from the disposal of the underlying asset at the end of the lease term if the asset were already of the age and in the condition expected at the end of the lease. Key points from the lessor's perspective, especially in a finance lease. Residual value matters when calculating the net investment in the lease. It includes guaranteed residual value. It means when the lessee gives the guarantee, in that case, the lessee will have to make the payment. The portion assured by the lessee or a third party unguaranteed residual value. In this case, lessee has nothing to do with residual value. The part not guaranteed but is still expected to be recovered. From lessee's perspective, residual value is not directly used in lease liability calculation. However, it may influence the lease term or assessment of lease classification in special situations, like if there's a purchase option. What is the treatment of residual value? We will go through it in the next slide. Now, there is an example for you. Okay. If in exam the question silent, so we will assume that the asset is sold at zero and the full GRV means guaranteed residual value will be recovered from the lessee. How we will recover? Let's solve this question. Orange Limited. Orange Tree Limited is neither a dealer nor a manufacturer means case 1. Orange Tree Limited entered into an agreement under which Orange Tree Limited leased a machine to Bean Stock Limited. Orange Tree Limited purchased the machine on 1st Jan 2001 at a cost of 2,10,000. So what is the entry made by the Orange Limited? We are solving the entries in respect of lessor, not with the lessee. So lessor made the entry purchase or machine debit, bank credit or cash credit by 2,10,000. Okay. The lease is a finance lease, terms of which are as follows. Inception of lease 1 January 20x1, lease period 3 years, lease installment 90,000, means rentals 90,000 annually in arrears of rate, payable on 31st December of each year. So we will have to calculate the present value. Now guaranteed residual value is 10,000, payable on 31st December 20x3. It means when there is a guaranteed residual value of 10,000, so it means lessee will have to pay this 10,000 when at the end of lease term. So when we are making a lease amortization schedule, so at the end of third year we will have to incorporate this 10,000 in the rentals, but not in the calculation of present value of lease liability. You have just studied here. Okay, so don't get confused. If there is a GRV means lessee gives a guarantee, so in that case lessee will have to pay or burden this payment. But how will lessee incorporate this figure? While making a lease amortization schedule at the end of this year, lessee will have to put this figure in the rentals. Okay. The interest rate implicit in the agreement is 15.581%. Prepare the journal entry and disclose it for each year. Now solve. First entry by the lessor machine debit cash credit 210210. FLR finance lease receivable against this machine 21010. Okay, first payments in arrears. Lease amortization schedule we are creating it here 123. Opening 210. This opening 210. On this there is an interest 15.5. Okay, this GRV 90,000. Now the closing balance is 1,50,000. This will become your opening for the next year. Again, interest income, again 90,000 paid by the lessee. So 86519. This will become the opening of the third year. Again, interest income. Now, the rentals which lessee pay to the lessor at the end of second year is 90,000. But at the end of third year, it become 1 lakh. Why? 90,000 of the rentals, 10,000 of the GRV figure. Look how we will incorporate this GRV figure. So it will become 1 lakh. Once you add both these figures, then deduct this, it will give you zero. It means the rentals or the payment of lease is done at the end of third year. Why? Because the lease is for the 3 years. At the end, you will make the entry bank 90,000 for the first year, means we receive or lessor receive 90,000 interest income 32722 FLR 86519. Now, there is a special case in continuation of the if lessor is a manufacturer or dealer. Lessor offers its customer a 0% interest lease. In reality, the stock is outdated, means asset is outdated, inventory is outdated. So this discount is basically a trade discount, and trade discount always affect the sales figure. Procedure. In this case, calculate present value of minimum lease payment using market interest rate, then record sales at lower of present value of minimum lease payment or fair value of asset. FLR debit, sales credit. Now solve one question on this. A motor dealer acquire vehicle of a particular model from the manufacturer for 21,000 at 20% discount on the recommended retail price of 26250. It offers them to sell at the recommended retail price with 0% finance over 3 years, provided 3 annual payments of 8,750 rentals are made in advance. The market rate of interest is 8% per annum. A sale transaction made on 1st Jan 2005 is recognized as a combination of an outright sale and a finance lease. The present value of the minimum lease payments is treated as the consideration for the outright sale, and the 8% is calculated as follows. Examiner also calculate the present value of lease liability for you, so you do not need to calculate the present value. Now solve. Okay, the case is not the case is relates with a manufacturer dealer. So inventory debit cash credit by 21,000. You can see the 21,000. Okay. Now there is a 0%, so lower of sales will be recorded at lower of present value of rentals, and fair value means retail price. So present value is 24351 and the retail price is 26250. Whichever is lower, of course, present value of rental. So we record FLR sales 24351. Cost of sales debit inventory credit because we made sales to 21,000 bank debit FLR credit. Why there is no interest income? Because the payment made in advance, so interest accrued over time. So there is a lease amortization schedule, of course, opening, then advance, deduct balance. On balance, you apply 8%, you will get closing. Your closing will become the opening for the next year, this and that. At the end, you will get 0. Why you are getting 3? Because of some significant figures. No need to worry about this. This is just a calculation error. So there is also a 0. So you will get at the end 0. Why 0? Because your lease payment has done, your all rentals has been paid. So there is a prepaid interest income. Again, income you booked as an interest, current asset. Now, conditions of finance lease. How will you identify whether a lease is a finance lease or not? When risk and reward of that asset has been transferred to lessee. When lease term is the major portion of assets useful life, say 75%. When asset is expected to transfer to lessee at the end of lease term. When present value of minimum lease payment is almost equal to fair value of asset at inception. When asset is of specialized nature and can't be used by others without major modification. So this condition is for the lessor, because lessor can follow finance lease as well as operating lease. Whereas for the lessee, lessee always follows the finance lease, but there is an exception in case of low value asset, and short term life. So you have to make sure in case of lessor accounting that whether the lease is a finance lease or an operating lease. So there are few examples which have been extracted from your past paper. So better to read these examples. You will get more clear image with regards to lease. Now, there is a last concept which is treatment of variable lease payments. In case of lessee books, present value of unpaid lease rentals. Fixed rental means rental, GRV, termination clause, penalty. But there are variable payment as well. Bargain purchase option, say 5% of sales. How to account for variable lease payments? Do they follow any index? Example, inflation, CPI clause, or your payment incorporated with interest. These payments are part of lease and they will also become part of ROUA and lease liability. How will you identify whether this one will be accounting for? There is an example. Landlord asked you means lessor asked you that I will apply increment according to the inflation rate after 2 years. Now, no need to predict future inflation rates. Of course, you can't. Just at the initial recognition, use unadjusted numbers. But at the end of year two, you need to remeasure the lease liability and ROUA using revised variable cash flows based on the increment. If they don't follow any index, percentage of sales, or according to usage such as photocopy machine, not part of lease payment, just book in P&L in the period in which it is incurred. Means if they don't follow any index, these index, then you just record it as an expense. You don't need to make this part of ROU and lease liability. So this is it for today's topic, IFRS 16. I hope I tried my best to clear your concepts. If you are facing any issues, feel free to discuss. I would love to solve your queries and reply you whatever you want to ask. If you want more clarification on this topic, I would like you to ask me questions anytime according to your convenience. So take care. Best wishes for your time. There is a little adjustment for you in case of dismantling. Dismantling of asset at the end of its useful life, dismantling cost to third party not become part of lease liability. It is other liability. So I will adjust this slide. Take care. Goodbye and best of luck.